Good afternoon, this is Stuart. We hope you're well. On this week's update, we'll quickly recap the Central Banking Conference in Jackson Hole, preview NVIDIA's earnings, discuss a more activist state industrial policy, and review valuations across the market. Last Friday, Federal Reserve Chairman Jerome Powell delivered what are likely to be his final remarks at the annual Fed's Economic Symposium in Jackson Hole, Wyoming. The key takeaways are that the Fed guided to a 25 basis point cut in the Fed funds rate at their September meeting, and remarks that a shifting balance of risks may warrant an adjustment to the Fed's policy stance, meaning that evolving employment trends may take priority over inflation concerns. The stock market interpreted this as a dovish speech and rallied strongly to close the week, with interest rates moderately falling. In the bigger scheme, we wouldn't put too much weight on Chairman Powell's preferences, as President Trump is almost certainly going to appoint a new Fed chair next year who likely supports his goals of lowering interest rates. We just note that while the Federal Reserve controls overnight borrowing rates, longer-term rates are subject to markets, with key variables such as inflation, economic growth, and fiscal deficits ultimately just as consequential as Fed policy. As for Fed policy, we can see based on the latest futures pricing that investors now expect 2 rate cuts before the end of the year, with the policy rate declining to 3% from today's 4.5% by the end of next year. More impactful to markets near term is NVIDIA's earnings update on Wednesday. The company, which has grown to over 8% of the S&P 500's weight, is expected to put up 50% earnings and revenue growth year over year. NVIDIA continues to benefit from an unprecedented demand for compute power, more specifically its GPUs, as tech firms build out data centers to support artificial intelligence models. Expectations are sky high, and what NVIDIA says about the sustainability of the AI capital investment cycle will have an impact on the entire AI technology and infrastructure ecosystem. We plan to follow closely its release and will report back with any actionable updates. Switching gears, the Trump administration announced it will be taking a 10% stake in Intel after previously providing grant funding under the CHIPS Act, as well as separate allocations for making secure chips. The deal, while unusual for the American government, should perhaps be viewed in the broader context of a more activist USA Inc. Just last month, the Pentagon announced it would take a 15% stake in the rare earths firm MP Materials after committing billions in support for purchasing its magnet material output. Both deals have a national security and geostrategic rationale. For MP, it was to counter China's dominance of certain rare earths markets, and for Intel, it's to make sure that the US has a homegrown semiconductor fabrication manufacturer. For better or worse, we think this is part of a new reality as the US seeks to counter both China's industrial and manufacturing strength and invest in technologies that maintain our technological and economic edge over the long term. Going forward, considering to what degree the government may have a vested interest in a certain company's or industry's success may become a more important variable in the investment analysis process. Finally, last week we discussed elevated valuations for the S&P 500. Today, we wanted to highlight a few sectors that are trading at cheap valuation levels despite continued sales growth. Two stand out from a performance and cash flow perspective: energy and healthcare. Energy, which is traded poorly as commodity prices decline due to near-term factors like moderate weather and the potential for peace between Russia and Ukraine, has a longer-term tailwind of growing power needs for artificial intelligence and the maturation of emerging markets. Healthcare has traded poorly this year over concerns including pharma tariffs, FDA staffing, pricing reform, and insurer malfeasance. There's certainly a lot to be negative about, but at current levels and with the sector down 17% year to date, we think much of that's priced in. It wouldn't take much in the way of good news to see these firms recover. And when we think about the impact of AI, healthcare probably stands to benefit most from improvements in the research and development process to better targeted patient care. Please let us know if you'd like to discuss anything we covered in today's update, or if you'd like to check in on your portfolios. Thank you and have a great start to the week.